All right, so welcome to our first session in Advanced Audit and Assurance. So the two topics we're going to be looking at are International Regulatory Framework and Code of Ethics. Then we will look at our SBR corner. Today's standard will be Revenue, IFRS 15. And in concluding, we're going to look at audit procedures when we are approaching revenue. So moving on to the first one. First topic is International Regulatory Framework. I decided to start with a scandal, right? So we're going to look at the Enron Scandal. Right, so the Enron Scandal. So this is one of the famous scandals, and this is why we even have these chapters. Every chapter pretty much refers to the various scandals, Enron, WorldCom, all of these. So let's just a quick illustration on the scandal itself. Firstly, let's use the cartoon image. So basically, Enron decided, persons were there, the executive decided they want to borrow money. So they chose a creative way. They want to borrow money, so they borrowed money. Typically, when somebody borrows money, then we know that, okay, the money go down, so we credit the cash at the bank, and then we debit the amount that is owed to us, right? So it's a receivable, so pretty much that amount is owed. So in essence, yeah, so somebody borrow money from you, or so it's like the director borrow money. So that's receivable from the director. Cool. So yeah, however, they decided that no, we're going to create special purpose vehicles or special purpose entities. So instead of having a receivable on the balance sheet, they ended up having an asset on the balance sheet. So you didn't know that it's the director owed the money. Director take $1 million or $2 million, they create these fictitious special purpose entities. So it seems as though the company has assets. So poof, some asset just come up on the balance sheet. Receivable would be an asset, but guess what? Receivable is something is collected when a name is attached. So what they did know, typically you would borrow against a receivable, would you? And a receivable you expect to be paid. However, an asset you don't expect to be repaid. So what they did know is that now the company needed money to borrow. So these directors also wanted more money, but the company was low on cash. So what they did was use these special purpose entities, these assets, as collateral to borrow money from the bank. So now, okay, so they are borrowing against something that don't exist again. So now this entity that you borrow $20 million, there is this entity that don't exist, worth $20 million, and that entity, non-existent entity, they borrow some money against it as collateral. So guess what? More problems. And then now, at the end of the day, when the loan is to be repaid, they couldn't repay the loan because guess what? The directors pocket the money. These special purpose entities don't exist. They are not tangible. They are nowhere. But at the end of the day, of course, can't pay the money. Then the director say, hey, I don't know you. I don't know what happened. So of course, company collapsed. Now, the funny part, which is not necessarily funny, is that the auditors were involved. Arthur Andersen. Famous Arthur Andersen. They were one of the biggest clients was Enron. Now, so what happened is that, of course, but Arthur Andersen, how they got in bed with them was that they employed the entire internal auditors, 40 internal auditors that Enron had. They employed them as their staff, they added their staff, and they actually opened an office in Enron's headquarters. So, they paid fees. So what Enron paid fees to Arthur Andersen for provision of, audit services. Arthur Andersen, on the other hand, disregarded all what was happening. And yes, so all of those things that are on the financial statements, they signed off on it. So the special purpose entities, which were really director loans that borrowed money, did what they want to do with it. Off balance sheet practices, all of that, they still sign off that everything is okay. Of course, when Enron investigation started, Arthur Andersen decided to do more. So they went on a shredding campaign. All documents started shredding. They just started shredding evidence, shredding evidence. Well, we know what happened. So Enron collapsed. Arthur Andersen went with Enron as well. So no longer Big Five, but Big Four. So that's basically a quick summary of the scandal. So then we get into the topic. So what factors led to the growth in regulation of the audit profession? That was one of the factors. So that introduction that we just used was one of the major factors. So in a sense, how would I approach a question like this? Of course, We need to think about why regulation was needed. Is there anything in the past, any precedent, whatever it is. So we need to consider the reasons why people rely on auditors. We also need to consider why people, may find the trust in auditors damaged, because that's something happened in the past. Now, so that's basically one of the type of requirements we'll have. It's not really a large question, but we're just doing this as a tutorial. We can do the longer questions later on. Suggested solution, some reasons. Reputation of the profession has been hit, mainly because of high-profile audit failures. So we have, yes, Enron, all of those other stuff. 2, the existence of auditing standards and other regulation, it should actually protect and enhance the reputation of the accountant. So you really want it to be protecting your reputation, enhancing it. In addition to that, of course, business have grown and become more complex. You have a lot of .com companies. So we have a lot of things, companies that are a lot of multinationals. So all of this, we need to be able to regulate businesses, know that they're becoming larger and more global, and we're in a smaller space. And finally, of course, is the competitiveness in the public audit sector has led to downward pressure on fees and a consequent impact on the quality. So you need regulation to ensure that at least the desired quality is maintained. So the main thing is reputation. And so one is basically reputation suffered. 2 is protecting and enhancing the reputation. 3 is that business has become more complex and global. And 4thly, it is pretty much that, as I said, there's pressure on fees to go down, so quality needs to be maintained. So you want to maintain minimal acceptable quality. So those are the main reasons why we have international regulations. So that's it. Because of everything that's happening, one of the things that normally pops up under this heading is money laundering. So we know there's a 3-stage approach to money laundering. So 1 is placement, so dirty money being collected. Then of course it's integrated into the financial system. Then layering now is when you start transferring it to various bank accounts, company X, company B, lending it to one company, payment on false invoices, etc., offshore bank accounts. And then integration, when it goes around and washed or rinsed, then they decide to purchase assets. So you'll find many times cash-intensive businesses usually do this. So for example, once it's cash-intensive, so you might find persons having wholesales, construction companies, a lot of these things where a lot of cash transactions occur. So in terms of the integration, they start buying trucks, they start buying buildings, they start buying various forms of asset land. So now the money seems to become clean. So it's integrated. So that's basically what we would say the 3 stages of money laundering. Now, what does ACCA say about it? So it basically defines it as this: the process by which you attempt to conceal true origin and ownership of proceeds of crime. That's in essence what it's saying, right? So is that your method of concealing the true origin of your proceeds of crime. Now, as auditors, though, we need to be particularly careful where this is concerned, especially, as we said, cash-intensive businesses. So cash-based businesses, we have to look out for that a lot. We mentioned the 3 stages, so placement, yes, introduction of the funds, layering, pass through a large number of transactions, and integration. Now it seems to become clean because it's now in the legitimate economy. It's also known as hide, move, and invest, right? So that's a simple way of saying what money laundering is. The 3 stages is hide, move, invest. The offenses itself include concealing criminal property, acquiring, using, or possessing criminal property, or becoming involved in an arrangement which is known or suspected of facilitating the acquisition of criminal property. So all of these things, as we know, so any criminal offenses, terrorist offenses, all of these things, financing these are all considered money laundering offenses. All right, so what are some signs? What are some signs that we can use to determine that it's possible that this is occurring? So it is not, what we say is not absolute to say that, okay, because there are complex transactions, it means that money laundering is existing. No, just means that these are potential signs that as auditors, with our professional skepticism, we're going to do more work to ensure that this is not happening, that it's not money laundering and everything is okay. Some of the signs are, 1, as we say, complex corporate structure. where the complexity, it doesn't seem warranted. Why so many special purpose entities? Why so many holding companies? Like, it doesn't seem warranted that you have all of these companies paying bills out to others, and it just don't make sense. Because you don't think they need 25 companies, probably 3 companies is fine, the other 20 just don't make sense. Those transactions not making sense. 2, transactions that are not in the ordinary course of business. A large transaction, but it's not acquisition of an asset or inventory or anything like that. There's large transactions, but it doesn't seem to be in the ordinary course of business. And as we say, a lot of cash-based transactions, which you don't expect. You would anticipate that they should go through the bank, go through their account, but they're large cash transactions. Also, transactions where there's a lack of information or explanation. Or yes, they give explanation, but it just don't make sense. And finally, transactions with little commercial logic taking place in the normal course of business. So it just don't make business sense. So complex corporate structure, transactions not in the ordinary course of business, large cash transactions, transactions that just the explanations don't make sense, and transactions that don't make business sense. So when you suspect money laundering, there's a big warning to the auditor, because you believe you saw the signs, you're trying to investigate these signs, but be careful, you don't want to end up tipping off the client. So it means then that, and what is tipping off is when you disclose something that will prejudice the investigation. So, and we have an idea when we tip off, what we mean by tipping off someone, okay? Right, so it's an offense to make the perpetrators of the money laundering aware that you have suspicion or knowledge regarding money laundering. And it's important to know. You can't make them aware that you're even suspicious, right? So yes, if you have knowledge, that's even worse. But even if you have suspicions or knowledge, so both of them go hand in hand. So either suspicion or knowledge, you cannot afford to tip them off. You cannot allow the perpetrators to know that you are doing that form of investigation. All right, that's a quick glimpse at some methods of money laundering. We kind of spoke to them a little earlier, but the terms that sometimes are used is one, smurfing or structuring, whereby you have lots of accounts, a lot of number of accounts, lots of individuals opening accounts, depositing money through various countries. Anytime you see something like that, those are some methods of money laundering. So just seeing too many individual accounts, too many overseas transactions with individual names. A second one is opening of accounts in fictitious or wrong names and addresses with false documents and proofs. And third is hand and glove with the bankers. So that they have somebody on the inside assist doing the transactions for them, wiring money to tax havens. Spelling is wrong right there. But yes, so wiring transactions to tax havens. All right, so that's it. So in terms of anti-money laundering program, so we know we suspect, don't tip off. Okay, what are the procedures in essence, right? So what are the procedures? So there are 5 main things that we need to know in terms of an anti-money laundering program. One of them is typically you're to appoint an MLRO, right? So this person basically what they're responsible to do, consider reports of money laundering, decide if there's grounds for these suspicions, prepare reports, that to the appropriate authorities when needed, and advise the team on how to work, how to approach it. So they should also be training employees on how to report the suspicions and design the systems and procedures regarding money laundering and the money laundering. So yes, so that's what is expected to do. So the first one is have an MLRO, right? And they might not call them MLRO. So there might be a partner in charge of that or whatever it may be. But the main responsibilities here is, yes, consider it, determine whether or not there seems to be ground for the suspicion, prepare the reports to the appropriate authorities, advise the team how to proceed, training, and of course, implementing anti-money laundering systems and procedures within the firm. The second thing is CDD or KYC. So yes, so customer due diligence, know your client procedures. So that's the second thing that is required. So now, the point of these procedures basically is to ensure that you can verify the identity of your clients. So whether it's an individual or an entity, you need to ensure that you have evidence of their identity. Now, for an entity itself, it might include a certificate of incorporation, registered address, the director's information. A lot of these are things that are required. So this is the second thing that we need to have in a money laundering program. Now, the third thing is enhanced record keeping. So a part of your anti-money laundering program is enhanced record keeping. So yes, appointing an MLRO, okay, good. CDD, KYC procedures. Third one, enhanced record keeping. So you need to keep your client identity, you need to keep the client's information, details of the transactions, and of course, we know at least for 5 years. Different jurisdictions have different length of time or period of time, but minimally in terms of what we say best practice is to at least keep all of this information, internal and external reports made in connection with any money laundering that you know, at least for 5 years. Fourth one is communication and training. So all the staff need to have an idea what is money laundering, what are the regulations, what are the things to look out for. So communicating to your staff regularly, training on these issues as they arise, especially as they evolve, it's critical to a part of what was a robust anti-money laundering program. So, and the fifth one is internal controls, risk assessment, the control environment, internal control, risk assessment, management, and monitoring. What the firm can do, basically it includes client screening procedures, systems and control to ensure that the training is actually taking place, and systems that allow periodic testing that the policies and procedure complies with your laws and regulations. So those are pretty much the 5 contents that you would have in your anti-money laundering program. So quickly, appointing the MLRO, your CDD or KYC procedures, enhanced record keeping, communication and training, and then of course, robust internal controls. So both, management and monitoring. And that basically covers, that's a synopsis of money laundering, anti-money laundering. Now, what comes up next, and this is the final part in the first chapter on the international regulatory framework, is now consideration of laws and regulations. So, of course, we're not going to read everything in the slide. You can always pause it and read everything you wish. So just the highlighted things. One, the auditor does have some responsibility, right, in regards to compliance with laws and regulations, especially where non-compliance has an impact on the financial statements. Now, there are 2 things. So the auditor, in terms of compliance with laws and regulations, the auditor responsibility is to identify non-compliance where it has an impact on the financial statements. In reality, the auditor has 2 responsibilities, right? So there's 2 responsibilities under this standard. And normally there's a mnemonic that is used, NOCLAR, right? Non-compliance with laws and regulations. So in essence, there are 2 things. Yes, we can know what the standard define non-compliance as, but what's the auditor's responsibility is 2 things. One, what is the impact on the financial statements of the non-compliance, because there might be fines, penalties, etc. And 2, is the impact severe on the business operations where would it affect the client as a going concern? So then, of course, the going concern assumption will become an issue. So the auditor have to consider 2 things: the impact on the FS and the impact on the client's operations, or how severe it is. Will it affect the business in operating, i.e. going concern? So there's 2 things: impact on the FS and going concern impact. Now, what are some indications? Again, signs. Just as how we might have some signs for money laundering, what are some signs that non-compliance may have occurred? Investigation by the government or payment of fines and penalties, payment for unspecified services or loans to consultants, sales commission or agent fees that appear excessive in relation to those ordinarily paid, purchasing at prices significantly above or below market price, unusual payments in cash, unusual transactions with companies registered in tax havens, payment for goods or services made other than to the country from which the goods or services originated, So, okay, you get it from Trinidad, but you're paying in Cuba. So payment without proper exchange control documentation, existence of an information system which fails, whether by design or by accident, to provide an adequate audit trail, and unauthorized transactions or adverse media comment. So these are all potential indicators of non-compliance. Again, nothing is absolute, and this is why as auditors, yes, we are skeptical, but at the end of the day, we need evidence, right? So we need to confirm using evidence. So, all right, we see the signs. Just as before, money laundering, okay, we see the signs, don't take them off. What's a good anti-money laundering program? Now, same thing, non-compliance, we have the signs, what are the audit procedures, where since we suspect or identify non-compliance. So we suspect it based on the signs, and after investigation, we identify. So there are 6 main procedures you would consider when as it regards to non-compliance audit procedures. 1, obtain an understanding of the nature of the act and the circumstances in which it has occurred. 2, obtain further information to evaluate the possible effect on the financial statements. So 3, if you suspect there may be non-compliance, you should discuss the matter with management and your appropriate TCWG. If management or TCWG don't provide sufficient information that supports, that entity is in compliance, of course, in the auditor's judgment, you have to look at the effect of the suspected non-compliance. Will it be material to the financial statements? And of course, as usual, always obtain legal advice. Before you do anything, typically, or anything to, anything that we're gonna make a decision, most of the time, obtain legal advice. And we're gonna see that a lot of the time in audit. So whether we're gonna say, hey, consider resigning, consider doing this, consider that, typically legal advice is one of those things, one of those default answers, but not just a default, you have to explain there's a process. So 5, if sufficient information cannot be obtained, then evaluate the effect of the lack of sufficient appropriate audit evidence on your opinion, right? So we know, so what's the effect? Okay, we don't have sufficient appropriate audit evidence. How will that impact the auditor's opinion? And finally, evaluate the implications of non-compliance in relation to the other aspects of the audit, including your risk assessment, internal control system, and the reliability of written representations, and take the appropriate action. Because they are not compliant, then of course, written representation becomes less reliable. Right? Because they're not compliant with certain things, they can't provide sufficient evidence as to whether or not they're compliant, then of course, written representation becomes less reliable. All right, we know that they are non-compliant. How do we go about reporting it? Now, yes, communicate with TCWG, the matter. If you suspect that they are the ones, then the next level, if there's a next level, whether they're audit committee or supervisory board. So the stages are 1, okay, non-compliance. Report it to management or TCWG. If they are the ones you suspect, then higher, go above them. So it might be the audit committee or a supervisory board. If there's no higher authority, then of course you need to consider obtaining legal advice. We talk about resigning, obtain legal advice. What can I do? Because these are the people I suspect, or these are the people that are the culprits. So reporting it to them is not really going to help. So, okay, legal advice. Now, if you conclude that it has a material effect on the financial statements and has not been adequately reflected, then of course you're going to express modified or qualified opinion or an adverse opinion on the financial statements. How about reporting it outside? So we just talked about reporting it inside. How about reporting it outside? If the audit has identified this, the auditor shall determine whether you have a responsibility to report it outside, and of everything you see there, most important thing is seek legal advice. Before you decide to go outside, seek legal advice. Yes, so you should recognize whether or not you should withdraw from the engagement, but even that decision, obtain legal advice. And that basically completes the first chapter. Okay, so let's take a short break.
Recording in progress.
Okay, so let's start the second section, which is Code of Ethics and Conduct. This one is a little longer, but hopefully you can relate to it a little bit. We're not going to spend a lot of time. So what I'm going to do is you can always, slow down the slides, but I just want to get some of the points across. So there are 5 fundamental principles and underpinned by independence. So the 5 fundamental principles: integrity, objectivity, confidentiality, professional behavior, professional competence, and due care. And of course, they're all underpinned by independence. So a quick summary of the 5 principles are: integrity, which means you should be straightforward and honest in all dealings, right? Whether business or not or personal. Objectivity, no bias, right? So that's one other thing. In short, no bias, no conflict of interest, no undue influence. Professional competence and due care, maintain your professional knowledge and skills and act diligently. So 1 is acquisition and 2 is maintenance. Confidentiality is refraining from, of course, disclosing people's stuff. So client information, keep it secret, keep it private, don't give anybody, don't use it for your personal advantage. Professional behavior is complying with regulations, laws, regulations, and avoid anything that may bring the profession into disrepute. And as we said, these 5 are underpinned by independence. Independence can be looked at 2 ways: independence of mind and independence in appearance. So yes, 1 is a state of mind where, of course, you are unaffected or not influenced by anybody else. Of course, in your professional judgment, it's there, unbiased. So there is professional skepticism and you're quite objective. Independence in appearance is now the avoidance of facts and circumstances that are so significant that somebody on the outside can look in and fairly assess and say, yes, this person seems to be objective and independent. So they're not connected whatsoever. So even if you are independent, if you appear to be not independent, then of course that is an issue, because then people are not going to trust you, right? So they're not going to rely on, they're not going to think the reports you produce are credible. It's going to affect the credibility of the information, because yes, you're independent, you're not connected, but if that person say, hey, they're friends, so I don't want to see their report really no value, no credibility, then we don't want to end up having another report where they don't attach any form of credibility to it. So it's 2 things. 1, independence of mind. So yes, state of mind, you have your conclusion, then you're unaffected, as I say, unbiased, and you had applied professional skepticism. Independence in appearance is where an outsider looking in can say, yes, man, that person is unbiased, that person can be skeptical. Now, with that, with the 5 fundamental principles, there are certain circumstances that threaten these 5 fundamental principles. And the circumstances will be self-interest, self-review, advocacy, familiarity, and intimidation. Simply put, self-interest, where you have some form of interest, financial or otherwise, or a relative has some form of interest. Self-review is where basically you're expected to give a judgment on something you're responsible for. So when a previous judgment needed to be re-evaluated by the professional responsible for that judgment. So you produce this report, you're asked to do something or review this report. Advocacy now is where, of course, your subsequent objectivity is compromised. So you don't seem to be unbiased anymore because you seem to be promoting the client. So that's advocacy. Familiarity seem to be friends. A lot of the interest, the relationship is so close that you end up having sympathy for the client, things that they want to do, things that they're doing, you allow them to do it and say, okay, that's fine. Intimidation is where you have actual or perceived threats, which of course may impact you being objective. And then we're going to look at some of these issues in detail. So we're going to look at some of them in detail. Now, we spoke about so conflicts of interest. Now, for example, a firm compete with client, or a firm has a joint venture with a competitor of a client, that's a conflict of interest. Now, professional accountant need to take steps to identify circumstances that could pose a conflict of interest. So that's what we're expected to do. So we should be able to look at, have reasonable steps to identify what are potential conflicts of interest, right? A threat to objectivity or confidentiality may be created when an accountant performs services for a client. So these are some possible things. So you perform the account, you do the accounting services, you do the audit, or it's something that is connected, right? So there's a potential for conflicts of interest. However, in some instances, you may have safeguards, right? So for example, safeguards. One, notifying the client of the firm's business interests or activities that may represent a conflict of interest. So in essence, let the client know that this is a potential conflict of interest and obtain their consent. So some safeguards, whenever you see there are potential conflicts of interest, number one, inform the client and obtain their consent. So inform the client that this is a situation, obtain their consent. Or notifying all the relevant parties, right, and obtaining their consent. So all relevant, not just this client particularly, but if it's two clients conflicting, notify both clients and obtain their consent. Or notifying the client that you as the accountant don't act exclusively for one client, right? And then of course, again, obtain their consent. So one is tell them the situation, obtain consent. Two, tell all of them the situation, obtain their consent. Three, tell them, look, I'm not exclusive, and obtain the consent. That, okay, you're not exclusive, so we understand that. Now, there are some additional safeguards that can be applied. So for example, preparing the FS, auditing the FS, separate engagement teams, procedures to prevent access to information so that separate teams, they don't necessarily have easy access to information. Clear guidance for members of the team on the issue of security and confidentiality. So if they're closely related, let them know, say, here what happened. No, you're closely connected, know each other, work the same place, but this is what we need to do. We need to ensure that we maintain this. 4 is the use of confidentiality agreements signed by employees and partners of the firm. And 5, regular review that the safeguards are in place. So in essence, regular review that, of course, the safeguards are being applied. Another thing is second opinions. When you're asked for second opinion, you have an idea what that is. So, okay, audit firm provide a qualified opinion. There are sometimes just opinion shopping. What do you do? Safeguards. So we have an idea what it is. So in terms of the safeguards, safeguards include seeking the client permission to contact the existing accountant, describing the limitations surrounding any opinion in communication with the client. So in essence, basically, tell the client that, look, I need to contact the accountant that gave you this opinion in the first place. Very important thing, the company or entity will not permit you to communicate and taking all the circumstances into account, then of course it is appropriate to provide the opinion sought. So if the company, and let's repeat that again, so if the company seeking the opinion will not permit communication with the existing accountant, then the accountant shall determine whether, taking all the circumstances into account, whether it is appropriate to provide an opinion. Meaning that, do you believe that, okay, since I didn't give me permission, should I really give an opinion? Or should I decide that, no, I'm not going to give a second opinion if you don't permit? So it is not, as we say, it is not black and white to say, okay, if you don't get permission, then don't provide an opinion. Means that you need to consider the position of the client. Ask, okay, why not communicate with them? If it is satisfactory, you have obtained adequate evidence, then of course you can now decide whether or not you provide an opinion. So this is not a black and white issue that they didn't give me permission, so I will not provide an opinion. It actually requires further consideration of the circumstances. Then now we get into the heavy stuff, which is key threats and safeguards. So, threats, various threats, so we spoke about self-interest threat, all of these. So these lead to certain risks, but then we can have safeguards to counter these risks. And that's what we're going to look at. So we're going to look at some examples of some threats, a lot of threats. It's a bit comprehensive, but we're going to see how we can simplify it. But a few threats, and then what are the safeguards that we can put in place. So 1, actual or threatened litigation by the client. So, okay, the threat litigation. What are some safeguards? So safeguards, if it involves a member of the team, removing that individual from the team is a consideration, or having a professional review the work that was performed. If the safeguards don't reduce the threat to an acceptable level, then the only appropriate action is to withdraw from or decline the audit engagement. So where there is actual or threat litigation, if it's a member of the team, remove the person from the team or have a professional review the work that was performed. And secondly, if it don't reduce the threat to an acceptable level, withdraw from the engagement if you're on it already, or decline the engagement if basically you're not yet, it's not yet a client. Second thing is gifts and hospitality. Okay, we can say the threats that create. What are the safeguards? It's not allowed unless it's trivial, right? So the existence and significance of any threat, it depends on the nature, value, and intent of the offer. And that's very important. So, and that kind of thing, that's very important in terms of knowing your safeguard. So gifts and hospitality, the existence or significance, it depends on the nature of the gift or hospitality, the value of the gift or hospitality, and the intent of the offer. Right, so it depends on that. So next is compensation and evaluation. Okay, so next is compensation and evaluation. So this is where a team member compensated for or evaluated on selling non-assurance services to an audit client. So that's another issue. So really the issues we're looking at here, like pretty much all the issues that come in exam questions. And then what are the safeguards? So again, this is something we can always play over just to make sure we capture the issues or use it as a reference point when we're approaching questions. So safeguards, it's not allowed for a partner. That's it, disallowed. So partners, no, cannot get compensation for selling non-assurance services to audit clients. Now, other senior team members, of course, if the compensation is material, then of course, remove them from that engagement. And another safeguard is quality control review. And this is going to be something that is repetitive. So quality control review is a safeguard for many things, many of the threats that you may have. So yes, it tells you about the various threats that have been created, the significance of the threat. It depends on the proportion of the compensation, the role of the individual on the team, and whether promotion decisions are influenced by the sale of such services. Again, all right, you have that. What are some types of safeguards? One is removing such members from the team, or two, having a professional accountant review the work of the member of the audit team. Right now, a key audit partner cannot be evaluated on or compensated based on the partner's success in selling non-assurance services. This is not intended to prohibit normal profit sharing arrangement between partners and a firm. So it's not a part of the profit sharing arrangement. So at the end of the day, they get profit share, that's fine. But they can't be compensated directly for obtaining non-assurance services to an audit client, from an audit client. Another one is fee dependence. So we see that there are lots of safeguards there. I'm not going to spend a lot of time on that, but one of the safeguards, public interest clients, the gross revenue, recurring revenue from one client is greater than 15% of the firm's revenue for 2 consecutive years. You need to tell the client those charging governance, done again, QCR, independent QCR or an external QCR, or after issuing the second year's opinion. It can be before or after, right? So, and that's for 2 consecutive years, because you just start a firm, the first client is going to be 100% their income. So there is some time, right? But if this is happening for 2 years, then of course, independent QCR, external QCR, but before or after the second year's opinion. For other clients, other than public interest clients, reducing the dependency on the client is a safeguard. External QCR or consulting a third party, right, such as a professional regulatory body or a professional accountant on key audit judgments. So ask a third party to the key audit judgments. So yes, since you're small, you have firms, okay, then use a third party to assist with key audit judgments. Right? So continuing on fee dependence, there's a good bit more, but of course, that's a little bit of reading. So you can always pause that and do that reading. Referral fee or commission. So how about referral fees or commission? Now, for example, so where the professional accountant does not provide specific service required, a fee may be received for referring a continuing client to another professional accountant or other expert. So they might be connected, okay, so okay, you don't do tax services, but you're not a tax consultant. Every time you refer to the tax consultant, you get 5 or 10% of the fee. Okay, what are some safeguards that occur? One is disclosing to the client the fees or commission that you may obtain based on the reference. So you need to disclose that to the client. And two, you need to disclose to the client any arrangement to receive a referral fee for referring the client to another professional accountant or obtaining advance agreement from the client for commission arrangements in connection with the sale by a third party of goods or services to the client. So in essence, what are the safeguards for referral fee or commission? Disclosing to the client, so basically disclosing to the client or obtaining advance agreement from the client for any commission related transactions. Overdue fees, quality control review, because it's overdue already. What are the safeguards? QC are important. So at least partial recover plan before starting the new audit work. So at least know, okay, if you can recover everything before the new year, or at least a plan, right? So it also means that your firm's credit control procedures are quite weak. So that's an indicator that your firm credit control procedures are weak. Contingent fees, that's not permitted for audit. It's widely used for certain types of non-assurance engagement. So it's important to note that contingent fees not permitted for audit. But yes, non-assurance engagement, widely used. What are some of the safeguards when, because contingent fees still going to give rise to self-interest, right? And advocacy, like if you're promoting the client interest. The safeguards is one, an advance written agreement with the client as to the base of the remuneration, disclosure to the intended users of the work performed by the accountant and the basis of remuneration, quality control policies and procedures, or review by an independent third party of the work performed by the accountant. Another threat, serving as a director or officer of an audit client. Again, that's not allowed. That's not allowed. Particular reference made by the code to the role of the company secretary, so the code speaks specific to that. If allowed under local laws or professional rules, then the duties and activities should be limited to those of a routine and administrative nature, not a management role. In essence, not a management role. Right, so now long association of senior personnel, including partner rotation with an audit client, types of threat that gives to familiarity, self-interest. Now again, the significance of this threat depends on how long the individual has been a member, the role of the individual on the team, the structure of the firm, the nature of the engagement, whether the client's management team has changed, whether the nature or complexity of the client's accounting and reporting issues has changed. What are some safeguards? Rotating the senior personnel of the audit team, having a professional accountant who was not a member of the team to do the work of the senior personnel, or regular independent internal or external quality reviews of the engagement. So a little bit more info there, but yes, that's a synopsis of that one. And then recent service with an audit client. So recent service, another self-interest, self-review, familiarity. So if employed during the year, so a safeguard now, if employed during the period for which the audit is being done, then there's no safeguard that is possible. So if this happens, so again, it's a recent service with an audit client. So, but if you are employed during the period for which the audit is being done, you don't have a safeguard. If before the period covered by the audit report, then existence and significance of the threat depend on factors such as the position of the individual, the length of time since the individual left the client, and the role of the professional on the audit team. Safeguard, review of work done by that person. Recent service basically means recent employment, right? So yeah, the person was employed by the client, it was during the year, then of course it cannot be on the team. Okay, so there's no safeguard. But if it was not during the period in question, then of course you have your safeguard. Now, temporary staff assignments. How about temporary staff assignments? So this is basically lending staff, right, to an audit client, and that may create self-review threat. Because your staff did the work, then now you come to the audit, your staff did it, you're not really going to spend much time looking at it. All right, safeguards. Now, such assistance may be given, but only for a short period of time, right? So, okay, doesn't prohibit it, but short period of time. So, but should not be involved in providing non-assurance services that would not be permitted under this section or assuming management responsibilities. In all circumstances, the client is responsible for directing and supervising the activities of the loan staff. So this will include conducting an additional review of the work performed by the loan staff, not giving the staff all the responsibility for any function or activity that they perform during the temporary assignment, or not including the staff as a member of the audit team. Other quick ones we're just going to run over is employment with an audit client. So that's also an issue that creates self-interest, familiarity, and intimidation threats. Also, we have family and personal relationships that create self-interest, familiarity, intimidation threats. So the safeguards we have there are: one, if there's an employment, as we said, if this is during the year, whatever, don't have an acceptable safeguard. So ex-firm member, not the client, significant connection between the firm and the individual, they don't have a safeguard. But of course, otherwise you can modify your plan, assign individuals to the audit who have sufficient experience, and have a professional accountant review the work of the former member of the audit team. Other threats that we possibly look at are business relationships. Right? What are the threats created? Self-interest, intimidation due to the actual or perceived pressure about losing the assignment. You have to assess what's the commercial relationship and do they have a common financial interest. Then you look at what are the possible safeguards, right? If it's material, then you don't have any safeguard, right? So if it's a material business relationship, no safeguard acceptable. Loans and guarantees, another thing. Team member or family member of the firm, okay, borrow some money or you lend the client some money. Of course, what? If not under normal lending conditions, then no acceptable safeguard. If under normal lending condition, then review by the network firm. Financial interest is a big one. So, of course, with the whole of financial interest in the client, that creates self-interest threat and intimidation threat. The safeguards guidance is given in terms of what are the possible safeguards. It also depends on the member of the team, the materiality of this financial interest, all of those things, right? So one of the main things is, okay, what's the financial interest? But of course, typically the safeguard is disposed of as quickly as practicable, right? So there's a financial interest, dispose of as quickly as practical. But it again depends on the level of staffing on the audit team, whether it's going to take them off or whether they really have to dispose of the financial interest. All right, custody of client assets is also another one. It's pretty much the final one that would be one of the major ones that is looked at in the exam. So all of what we looked at are the major threats that you may find in an exam. Should be able to understand the threat, what are the risks that they pose, what are the potential safeguards, if any. Now, another thing is providing non-assurance services to an audit client. So we looked at those, but another thing is providing non-assurance services. So automatically, so by default, 3 threats are created. Once you provide non-assurance services, by default, 3 threats are created: self-review, self-interest, and potentially advocacy. And this is why we need to know, okay, how do we approach, and then what are the possible safeguards? One is to ensure that we don't take on management responsibility. So that's one of the major ones, providing non-assurance engagement. The issue that is dealt with, so there are 3 things. One is management responsibility. 2, preparing financial statements. That's another one, preparing financial statements. So how do we approach that? Preparing financial statements, what are the possible services, payroll services, recording transactions, etc. What are some examples of safeguards we may have? And most importantly, when it comes to public interest entities. All right. So only in emergency situations that you can provide these type of services, right? Outside of that, when it comes to public interest entity, you should not be providing such services. And thirdly, valuation, another major non-assurance one. Valuation, it's not normally allowed, right? If it has a material effect on the, because generally it have a material effect on the financial statements. Internal audit is another, right? So that's another service. Okay, again, issues, public interest, right? You know, when it comes to private companies, public interest entities, you can look at what their safeguards are. For public interest, there's none really, especially if there's over financial reporting. So when it comes to that part, you should ensure there's none for in terms of the internal control system when it comes over financial reporting. But for private entities, you can segregate the teams. The board should acknowledge responsibility that it's their role, their responsibility. Okay, so yes, you're doing internal audit, but make sure say you don't have nothing in terms of the design of the internal controls over financial reporting, anything that impacts financial reporting. IT systems is also another. Okay, so you might provide IT services. Again, nothing in relation to financial reporting for public interest clients. So public interest clients stay far away from anything that relates to or leads to the financial reporting control system. Recruitment services. Again, yes, public interest clients, not allowed for directors or senior positions. So yes, you can assist with that, but anything that relates to persons preparing the financial statements, then no, you should not be able to be a part of that appointment. Otherwise, final decision should be the client, of course, and you do not negotiate on the client's behalf. So you don't negotiate salary, don't negotiate packages on the client's behalf. Finally, some other things are corporate finance services, taxation, litigation support services. So corporate finance services is not allowed to promote shares, dealing shares, or underwrite shares. Taxation is okay if management takes responsibility for the returns. Litigation support services, it may include activities such as acting as an expert witness, all of those stuff. Now, these create self-review advocacy threat, and if significant, it will be the same safeguards as valuation services. And that's basically ethics. So just a quick look at how do we approach ethics question? So just a quick look at it. And I'll just look at the highlights. No worries, no worries. So it's commonly examined in the exam. So in the exam, that's one of the commonly mentioned topics, but it's done alongside practice management issues. So usually ethics questions commonly examined alongside practice management issues. So what that means basically is that your answer needs to cover both. So usually it's a question with ethics and practice management. So typically an answer must cover both. Sometimes persons end up covering one and not covering the other. That's a deficiency. Now, in terms of technique, we need to understand the basic principles, right? So in terms of technique, the first thing is understand the basic ethical principles. So it's a starting point for you to assess the scenario, look at what are the threats that are posed, what's the risk, and the potential safeguard. So that's basically the starting point. Understand basic ethical principles. Now, usually you're going to find that some exams, you'll see how the issues are sometimes interlinked. One of them, for example, in June 2013, there was a question where a new audit client requested advice on the acquisition of an existing audit client, while also wanting financing advice on the potential purchase. So, okay, these are two clients, and one client asking you basically to give them advice. Should I obtain this other client of yours? And I need financing advice on how should I purchase this client of yours? Now, it requires consideration of the issues involved in offering advice. So that's one. So what in terms of offering advice, are you competent to offer advice, and what are the potential independent threats? Now, the target FS has been audited by you as well, right? So of course, there's a conflict of interest between the clients. There are also confidentiality issues. So those are some of the things you'd have to pick up from out of this scenario. Another thing is questions may also require competency judgment to be made regarding the staff, right? So how competent are the staff members, right? Did they assign them appropriately? Right, so such as question 2 in the June 2013 exam. So now this question requires discussion of which tasks are appropriate for which team member in specific audit situations. Now, the thing is now, each situation presented may have subtle considerations, which mean that the basic rule must be examined more closely. So yes, okay, and the question just came, and okay, which one, who's the appropriate person to look at this component, etc. Now, finally, in December 2013, one scenario presented a request for valuation services by a listed client. So again, understanding the regulation and the specific, especially with regard to public interest and those that are not public interest, is very important, because you might be writing a whole heap when the guidance says no. They might just say no or yes, but only, right? But you're there writing, think that, okay, it's 5 marks, I need to just keep writing. Okay, so now in order to tackle requirements, how we tackle them? There's a need to identify the relevant issue, show how it relates to the rule, right? So that's how we tackle it, right? Yeah. Right, so there's a need to identify the relevant issue and show how it relates to the rule. For example, in the case of the acquisition above, there is a self-review threat because it's your client, right? So this is a client of yours. So, okay, you're going to advise them whether you should acquire the client. You did the work on the client. You did the audited financial statements. Identifying that self-review is an issue, and it may score a half a mark. In order to score well, the risk of self-review must be explained in relation to the scenario. And that's important. So yes, identifying it is just a half mark. You now need to state what are the risks, and then of course if there are any potential safeguards, you deal with that, expand upon that. Now the reds, common error where students, now this is a common error where students who have identified the right issue, they go on to score badly. Why? Through a lack of specific explanation in relation to the scenario, or through use of circular reference, where they say there is a self-review threat because the auditor will be reviewing their own work. Okay, so that circular reference means you reach nowhere, right? Such an answer, it doesn't explain what happens as a consequence of self-review, hence why it is a threat, nor does it apply the issue to the scenario. So it's very important to make that connection. So of course, for answers, we'll just give circular reference. We don't want to do that. We need to state why is it a threat in relation to the scenario, the risk that it poses, and of course, the potential safeguards. Now, looking at the 3 questions quickly that was mentioned. The June 2013, the self-review, the new audit client wishing to purchase the existing client, but possible answer, the due diligence review may lead to a self-review threat, as the firm will be reviewing financial statements on which it has already given an opinion and may be reluctant to highlight errors. So we see the highlights, right? So new audit client, not self-review because you're reviewing your own work, but self-review because you give an opinion and you're reluctant to highlight any errors. That is clear, right? The advocacy threat. Same client now, because remember they were seeking financing advice. Okay, why is it an advocacy threat? Advocacy threat may arise if the firm appears to be promoting the client in negotiations with the bank. So that's a clear explanation. Now, the other one with the overdue fees in December 2013. Now, what's the potential answer? Overdue fees could in effect amount to a loan to the client. Good. So highlight the loan, a tick there. In such cases, the auditor may be tempted to provide a favorable opinion, a tick there, in order to increase the chance of fee recoverability, another tick. Okay, so that's basically where you have overdue fees, self-interest. Now, how about the owner, the December 2013 question, owner managed business requesting audit and business advice. Okay, how you respond to that? Providing business advice may result in the firm taking decisions which are the responsibility of the client. And then the final two from December 2012, familiarity and intimidation. 1, prior audit manager Bob is being considered for the finance director role at the client. Okay. Bob will have a previous working relationship, so he will start stating what happened, with the audit team, causing them to trust him more and therefore lose professional skepticism. Full mark. Continuing. Bob will also know the firm's audit procedures and be able to circumvent them. Another full mark. Right? So that fully explains the familiarity threat. And intimidation threat is same, Bob. Why intimidation? Junior members may feel intimidated because what, Bob? Because he was previously their manager and they may fail to challenge him properly. Right? So that's basically how you have marked with credit. And of course, you move on to your safeguards. So of course, following the answer, you're going to look at what can you do? What action should the firm take? The recommendation should be specific to the scenario given and carry an amount of commercial sense. Just don't, basically saying, don't just talk foolishness, right? So make sure it makes business sense. So the recommendation, the safeguards, and this is why we went through so many safeguards, because it's good to have an idea. Okay, this is the threat, so loan, fees, commission, all of this stuff. Here are the potential safeguards. So you'll be able to connect rather than just guessing. Yes, I know the threat. I know the risk. I can explain it. All right, let me just come up with a safeguard out of the hat. No, we need some guidance. No, because what the examiner said, this is one area where weaker students struggle most, which is the safeguards, being specific to the scenario and making business sense. Another common mistake for students, right, is to not take account where in the audit cycle you are in the question. That's another common mistake. Is this a new client? Have we already provided an opinion? Right? Are we about to provide an opinion? Right? Or are we just starting the engagement? So if the audit has already happened, where an independent issue comes to light, then replacing the auditor for the final audit is not an option. And this is why it's important to look at where are you in the audit client cycle. And that's important. Your answer not going to make sense if you're in the wrong place. So if you're giving an answer as if this client is a prospective client, or you're giving an answer that here what we completely give the opinion already, we've already given the opinion, then, and that's not the case, then you have a problem. No marks. So you can write as much as you wish. The wrong part of the cycle, no marks. Now, similarly, if the firm is considering a new client, they can't resign during the tender stage as they haven't been appointed yet. So if you are considering as a prospective client, using the word resignation is meaningless because you have not been, you can't resign, you're not appointed yet, right? So you can decline to the engagement, but you cannot resign because you have not been appointed. Conversely, if we have a new client, we already have been appointed, and then it's too late to start carrying out acceptance procedures. So if it's already a client, then speaking about carrying out client acceptance procedures is meaningless because you already accept the client already on the engagement. So this is that's what the examiner is highlighting, that look, ensure you figure out where are you in the audit client cycle. Now, when recommending actions in the exam, the basic rule the examiner says, when recommending action, the basic rule is to reduce the threat to an acceptable level. That's the basic rule. And if that is not possible, avoid the threat through not accepting the assignment or withdrawing. So basic rule, reduce to an acceptable level. If not possible, avoid the threat through not accepting the assignment or withdrawing. Final word of caution that is given is check your answer has the right focus. Always keep in mind the answers will be the actions for the auditor and not the client's management. Something that comes up a lot. So what the examiner says is ensure that these are the actions for the auditor, not the client's management. So, okay, sometimes when people connect business risk and all that, they end up they're starting to know, look from the client's perspective, what the client needs to do. No, what are the actions you as the auditor need to take? A common exam review point that students often spend time in the exam writing on such things at a tangent to the requirement that has been set. So it means basically that the answer have a lot of depth, but no marks, right? So yes, because guess what? You're responding to the wrong questions. You have the right answer, but to the wrong question. And of course, no marks for that. Finally, keeping the focus on the auditor in the exam will enable students to answer the question set. So bear in mind, you're the auditor, you're the auditor, you're the auditor from that perspective. Yes, so that basically completes the second chapter. So break for a second and then we'll see if we can look at revenue. Okay, so now our SBR corner. So we're looking at revenue today. So we are going to go straight into this standard. Now, basically, we have an idea of revenue. So income arising from ordinary activities, who is a customer, someone you're contracted, someone who's contracted with an entity to obtain goods or services that are the output in your ordinary activities. Now, one of the main things we're going to see, we're going to focus on a little bit is this 5-step approach or 5-step model with regards to revenue recognition. And we're going to look at various examples for each step. So the 5-step model looks at it in 1, identify the contract or contracts with the customer. 2, identify the separate performance obligations. 3, determine the transaction price, and that one even have some conditions. 4, allocate the transaction price to the performance obligations. And 5, recognize revenue when or as a supplier satisfy performance obligations. Now, before I mentioned the 5 steps, but there is generally the normally considered 2 fundamental performance obligations, right? And that's above, which is considered the core principle. So the 2 fundamental ones is 1 is, of course, recognize revenue 1 in a manner that depicts the transfer of the goods or service. And 2, at an amount that reflects what you expect to be entitled to. Okay, so those are basically those 2 performance obligations, are the 2 core principles. So yes, so of course, transfer occurs in a manner, so you recognize it where transfer occurs. 2, at an amount that reflects the consideration that you expect to be entitled to. All right. So here's a quick example on the summary guidance. So Xplc, software developer, enters into a contract with a customer to transfer a software license, performs an installation service, and provide unspecified software updates and technical support for 2 years. All right, so okay, software developer, few things, the license, installation, unspecified updates, technical support for 2 years. Now, IFRS 15 provides guidance in the following areas. 1, whether the contract is within the scope of IFRS 15 and what to do if it does not apply. 2, if it applies, whether the contract contains a single performance obligation or separate performance obligations. So we have the license, installation, and the updates. 3, how to identify the transaction price and whether they should be adjusted for the time value of money. Right, so of course, normally if the payment is more than a year, then you have to start considering the time value of money. The 4th one is how the transaction price should be allocated to the separate performance obligations. And 5, whether the performance obligation is satisfied over time or at a point in time. Okay, so is that specific intervals or over a period of time? No, it's generally straightforward for many contracts, but of course, sometimes there are some complex contracts. And as I said, know that revenue recognition and invoicing, 2 separate processes. So not because invoices are prepared mean that the revenue should be recognized. So that's an important thing to note. So yes, the client prepared the invoice or you prepared an invoice, it doesn't mean that you're going to have to recognize the full revenue immediately. Because of course, the conditions have to be satisfied. So we're going to look at the 5 steps. We're going to look at them one by one, a little bit more detail on each of the 5. So 1 is identify the contract or contracts with the customer. Okay. The first step, identify the contract. It can be written, oral, implied, right? So, okay, so it can be any of those. Now, definition of a contract is an agreement between two or more parties that create enforceable rights and obligations. Now, of course, internally, the reason why I decided to identify the contract or contracts with the customer is that it can be two or more contracts that you enter into, right? Now, if there are two or more contracts at the same time or near the same time with the customer, you should combine them and treat them as a single contract if one or more of the following conditions are present. So there are several contracts, but I went into these contracts almost simultaneously. You can treat them as a single contract if it satisfies one or more of the conditions. One is that, okay, they are negotiated as a package, that's single business objective. Two, the amount to be paid in one contract is dependent on the price or performance on the other. So they're connected, so pretty much one merged. And three, the goods or services promised in the contracts are a single performance obligation. So simplified, yes, combination, several contracts entered into simultaneously. All right, if they were negotiated as a package, treat them as one contract. If one depends on the other, treat it as one contract. If basically it's a single performance obligation for all of these, then treat it as one contract. Here's an example. So we're gonna do some quick questions. So Xplc car dealer entered a contract with Mr. A. So I'm gonna give you a minute to read, and then we analyze it. So give you a minute to read, then we analyze using the questions below. All right, so now car dealer, this person, they sell him a limousine, $25,000 deposit, but they agree they're gonna pay the balance based on the income that they earn. No experience in the industry is highly competitive. So this is a man new to the industry, pay 25% of the money. He says he's gonna pay the balance based on what he gets from this business. Now, you can repossess it, but there's no further compensation. So you can repossess it, and if it doesn't, so let's say it devalues, so it crashes it, repossess it, can't sell it for the balance, you only can sell it for $50,000. There is no default, you can return to him. So it's non-recourse, you can return to him and say, here what, it's only 50,000 this is worth now. You pay 25 and need the other 25 from you, it's non-recourse. All you can do is repossess, that's it. Okay, so analysis now. Have the parties approved the contract and are committed to perform their respective obligations? Yeah, it's approved. They're committed to perform the obligation. So that seems okay, that's true. Can Xplc identify each party's rights? Yeah, it's clear. Yeah, so that's okay, fine. Can Xplc identify the payment term for the goods and services to be transferred? Definitely, it can be identified, yes. Does the contract have commercial substance? Yes, it does have commercial substance. Finally, is it probable the supplier will collect the consideration? That's a trick question. Because this is somebody who new to it, face high level of competition, it's a non-recourse agreement. Is it probably you're going to collect everything? The only thing is no. Why we say no? Because if you repossess this vehicle and it's not worth the amount that is outstanding, you are going to suffer a loss because it's a non-recourse loan. And so if you notice why it's important to look at this, so we could recognize everything. We don't think about recognizing the revenue because we're getting yes, 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 yes. But the final thing now is basically, do you reasonably expect to collect everything? All right. So it's not probable, as we say, that they will collect the consideration because if you tend to repay an income derived from something with a lot of risk, you don't have any other assets. And of course, it's a non-recourse loan, so you really can't go back to it. Now, when that happens, what do you do? any consideration received in respect of a contract that does not meet the criteria is recognized as a liability. So the default, if it doesn't meet the revenue recognition criteria, you're going to recognize it as a liability, as if you owe the person until the performance obligation has been met. So it has to be recognized, so you can't recognize it as revenue yet. So the default for the 25,000 is a liability. But we can discuss it and see whether or not it's going to come outside a default. But it's always important to know what the default is. Okay, doesn't meet IFRS 15 criteria, cannot recognize it at this point in time, it is a liability. All right, so you must recognize the 25,000 received as a liability until either it becomes probable that the consideration will be received or until the revenue recognition criteria is met. Let's look specific now. So that was the default. Now, this is where Xplc's performance is complete and substantially all the consideration have been collected and non-refundable. So in this case, he has collected the $25,000. He has transferred the vehicle to the individual and the deposit is non-refundable. So in this case, the $25,000 can be recognized as revenue because he has met the performance obligation, transfer has occurred, okay, and then the deposit received was non-refundable. So then, of course, it can be recognized as revenue. So, step two. Step two is that at the inception of a contract, a supplier must determine whether the contract is for the sale of a single deliverable or several deliverables, right? So, the performance obligation, and as we said, so identify the separate performance obligations in the contract. So, that's step two. All right, what's the definition? What's a performance obligation? Is a promise in a contract with a customer to transfer either a good or service that is distinct or a series of goods or services that are substantially the same. That's in essence what it is. So you promise that basically you're going to transfer goods or services, whether they're distinct or a series of distinct goods or services. So that's basically what, in essence, a performance obligation is. Yes. Okay. Okay. So here's an example. We're going to look at a few examples quickly. So Xplc is a contractor which enters into a contract to build a bridge for a customer. Now, Xplc is responsible for the overall management of the project. The project involves the provision of various goods and services, including design, site preparation, and construction of the bridge. So let's now analyze. Can the customer benefit from the goods and services either on their own or together with other readily available resources? So can they benefit from it? Yes, Xplc or its competitor regularly sells many of these goods and services separately to other customers. The next question. Is Xplc's promise to transfer individual goods and services in the contract separately identifiable from other promises in the contract? No, because all of that seems all combined, the design, site preparation, construction. So a lot of these things are all in one, like a package. So Xplc provides a significant service of integrating the goods and services into the bridge, which the customer has contracted. So what's the conclusion? Xplc should account for all of the goods and services in the contract as a single performance obligation. Another example, because you have separate scenarios. So, same Xplc is a mobile phone company. They sell mobile phone contracts under which a customer receives a handset and a contract under which the handset is connected to the network for a 24-month period. Now, monthly payments made by the customer, and I'm going to give you a minute to read it because I don't want to read so long and then do the analysis. So I give you a minute to read and then we'll do the analysis. All right, so analysis. Can the customer benefit from the goods and services either on their own or together with other readily available resources? Yes, the customer can benefit from each of the goods and services either on their own or together. Next question. Is Xplc's promise to transfer individual goods and services in the contract separately identifiable from other promises in the contract in this instance? Yes. Right, the handset and the network uses are separate outputs instead of inputs used to produce a combined output. So what's the conclusion? Xplc should account for 3 separate performance obligations: the handset, the network service, and the network use. Right. Okay. Another example. Mobile phone company. Now, sell mobile phone contracts under which a customer receives a handset and a contract under which the handset is connected to the network for a 24-month period. All right. Monthly payments made by customers entitle them to send specified number of texts, a specified number of call minutes, and a specified data download volume. Usage in excess of the specified amounts incurs an extra charge. Xplc does not sell the handsets and network connections separately. Okay, so analysis. Can the customer benefit from the goods and services either on their own or together? Yes, they can benefit from the handset and the network contract together. Okay, but of course they can buy extra usage. That's a separate benefit. Now, is Xplc's promise to transfer individual goods and services in the contract separately identifiable? No, the handset and the network use are a single input used to produce a combined output. The sale of extra minutes is a separate output. So what's your conclusion? Xplc should account for 2 performance obligations. The handset and the network contract is a bundle, and the network use above the specified minimum. So 2 performance obligations. All right, so moving from step 2 now, step 3. So definition, first determine the transaction price. Now, the transaction price basically is the amount of consideration the entity expects to be entitled to. So that really is it. So the transaction price is the consideration you expect to be entitled to in exchange for the goods or services. All right. Now, a supplier must consider the terms of the contract and its customary practices in determining the transaction price. There are a few factors that actually impact the transaction price, and we'll look at it in a few minutes. So a few things that impact the transaction price are variable considerations, the time value of money, non-cash considerations, and consideration payable to the customer. So step 4 is allocate the transaction price to the performance obligations. So the objective is to allocate the price to each performance obligation in an amount which the supplier expects to be, again, entitled to for transferring the promised goods or service. Right, so the transaction price is allocated to each performance obligation in proportion to the standalone selling prices. So, okay, if you were selling the phone by itself, if you were selling the package by itself, how much would that be worth? How much would that be valued? And then, of course, that's how you're going to recognize it. So, definition: a standalone selling price is the price at which an entity would sell a promised good or service separately to a customer. So that's what the standalone means. If it was sold separately, what would be the price? And then step 5 is recognize revenue when or as a supplier satisfies the performance obligation, right? And it might be satisfied over time or at a point in time. So as I said, recognize it when or as you satisfy the performance obligations. And it can be satisfied over time, in which revenue will be recognized over time, or at a point in time, in which you recognize it at that specific point in time. So a quick example, a quick illustration, and looking at the 3 steps, right, is revenue recognition. So Xplc sells mobile phones and network contracts either together or separately at the following prices. So either together or separately at the following prices. So now Xplc sells, so now let's look at it now. So separately as a bundle and as a bundle. Separately the handset, $531, contract per month, $25, contract period, 24 months. What would be the total network contract? $600. If you do it separately. So if you look, so let's look at it. So how we get the $600? You follow that? Total network contract, all of those are added, right? Those are add-ons. The 1131 says 531. Plus the $600 give you 1131. Okay, cool. As a bundle, yeah, man, as a bundle, so it's $25 per month for 24 months. So that's it. So, all right. So that's how we get the 600. Wonderful. All right. Now, as a bundle, nothing for the handset, but now you get is really $50 per month, 24 months, that's $1,200. So the total cost you have there, $1,200. So if you notice here, separately, the total cost will be $1,131. As a bundle, it's $1,200. So now revenue from selling a bundle will be recognized using the following steps. Step 3, determine the transaction price. Transaction price, $531 for the handset and $600. That's why I'll give you the $1,131. Now, as a bundle, the transaction price is $1,200 for the handset and the contract sold as a bundle. So everything together is $12. So, all right, we know it's $1,200. How are we going to deal with this now? So, proceeding to now look at step 4 and 5. The first instance, we're ignoring the time value of money, right? And then we're going to look at it after with the whole time value of money because it's more than a year, right? It's more than a year, 24 months, 2 years. So we know we're going to consider that, but we're not considering that yet. How we allocate it? We're going to allocate it based on the handset would have been $531 out of the total value of $1,131. And the network usage, bonded network usage would have been $600 out of the $1,131. So you prorate it based on that. And this is why I look at it separately. What proportion would the handset be of the total? What proportion would the network contract be of the total? And then your proportion of the bundle as well. So 531 over 1131 times 12, and the 600 over 1131 times 12. That's what you do. So the handset, 563.40, the network contract, 636.60. And then now step 5, how you recognize it now? The revenue for the handset can be recognized upon transfer. Right, so the revenue for the handset can be recognized upon transfer because you give them and transfer occurred. So you can just recognize that immediately because they get it, you have transferred it. So they have received it. Okay. So now, so there's no cash received though. So nothing was paid. Right. So that means, all right, nothing paid. So nothing is paid. However, I'm going to recognize revenue. So credit revenue, debit receivable for that 563.40. The network now, that's now over time. It's 24 months, that's all. So if it's over a 24-month period, then we're going to have to recognize it over that period. So let's look at it. The cash, so as I said, the difference between the cash received each month and the amount recognized as revenue in the statement of profit and loss reduces the receivable to 0 by the end of the 24-month period. What that means, so the 636 that you have, as I said, you divide that by 24, right? Divide that by 24, recognize that. And then, of course, you receive $50. And remember, you had a receivable of $563.40. Why we have the receivable is because the customer didn't pay nothing upfront. All right, cool. So the customer paid nothing upfront, right? So quickly looking back at just the previous slide, not forward slide, previous slide. So here, the customer paid nothing upfront, but this is how we did the breakdown. So the handset is worth $563.40. The network contract $636.60. Okay, so that makes the full 1200 package. Now, in terms of the commercial reality, so it's 1200 is a package. You told the customer that they pay nothing down. just paid $50 per month for 24 months. So you didn't receive that 563, but you gave them the handset. So the performance obligation was satisfied. So you can recognize the revenue for the handset because they have the handset. Okay, so you recognize all of that immediately, but no cash was received. So that is a receivable. What the customer is doing now is that the amount that the customer pays, right? A part of it reduces the receivable and a part of it is for the monthly bundle. Part of it is for the monthly package, right? So the monthly plan that they have, so they pay the $50. We know that a part of it is basically reducing the amount that they owed us, but they didn't come with any cash up front. And then it's also paying for the monthly package. So then that's how we're going to have to split it. Now, we know the monthly package is $636.60. So they're really paying, so the amount that is for that will be $636.60 divided by 24. Right? So that will be $636.60 divided by 24. So $636.60 divided by 24 give you $26.53. So when you do that, then that means then that the amount that's going to reduce the receivable is the difference. How we can check if this makes sense, right? So if each month they are paying $50, $26 basically is going against the revenue, $23.47 is going against the receivable. The $26.53 is going to revenue because of the monthly plan, right? And then the $23.47 is going against the amount paying for the handset. But you can, if that makes sense, you multiply the $23.47 by 24 months and see if they finish pay for the handset in 24 months, right? So the $23.47, that difference you have there, so that $23.47 multiplied by 24, or you could have divided 536, but anyone is fine. So you could either just say, the 563, they're paying that over 24 months. How much should I recognize? 563.40 divided by 24. That's what they're paying. So out of the $50, you can get home revenue. I get my revenue. Home I get my receivables. All right. So over the life of the contract, as proof, you're going to receive $1,200 cash because it's 50 times 24. And then, of course, what you have as the revenue for the plan is $636.60, and what you had for the handset is $563.40. All right, but this one, of course, don't take into account the time value of money. Taking into account the time value of money would mean whatever you receive over a year period, you're going to have to, look at the impact of, the reduction of value of money over time. Yeah. So, but don't worry, we're not going to take into consideration the time value of money, no. So we'll leave that for another time where you can take into consideration the time value of money. There are other factors that affect the transaction price that I will just advise you to look at, research, is variable consideration, discounts, financing component, and non-cash considerations. So under variable consideration, you have to look at royalties, refund liabilities, discounts. Basically, of course, the only way you're going to really recognize it is if it meets a certain criteria. Financing component, this is basically, of course, we are taking into consideration there's some financing being offered and any non-cash considerations. So those are some things, and other aspects IFRS 15 looks at are contract modifications, contract costs, and presentation. So I'll share the slides just in case you can read up on those. So those three are offered, and another thing you need to look at are some specific examples. But again, as I said, I'll share the slides. The ones that we didn't look at, you can probably just take a glimpse on it. You don't necessarily need the text, you can just do a little research on just those areas. And in wrapping up, just have about 3 minutes, just quickly, audit procedures regarding revenue. So audit procedures regarding revenue, one thing. And this will be a slide that's in everyone, right? For audit procedures, always remember you have some useful checks. So this is like the basis for all audit procedures. 1, what documents might be available? 2, any third party who can provide written confirmation? 3, would a written representation help? 4, what post-year-end event may have occurred that would help assess the year-end accounting treatment? And 5, could this have happened in previous years? If so, compare. So these are 5 critical things that you can use. So for audit procedures in anything, any component, whatever you're looking at, take this approach. Okay, what documents are available? I wonder if I can get some third-party confirmation. Will a representation help, or is there something that happened subsequent that may assist me in knowing what the year-end accounting treatment is? And did this happen in previous years? If so, we can do a comparison. Another way to look at it is in an AIOU, analytical procedure, inquiry, inspection, observation, recalculation. So it has that. Now, I will say that once you know the basis of what you look for in when you're looking at audit procedures, documentation, etc., the second thing is, okay, what does the applicable standard state? So having a little idea, okay, revenue says, all right, there are 5 steps. What are the 5 steps? I have a little idea how to look at these 5 steps, whether the performance obligation has been met, how do I determine the transaction price, when am I recognize the revenue, etc., etc. So I have an idea that that's good. So knowing the basis of your procedures, what are the requirements on the applicable standard, and then thirdly, what are the assertions I'm testing? Because I don't just want to test blindly. So just in case there's some guidance, because typically we have guidance whenever we do audit, we have our audit plan or program, whatever. But what if something is missing? What exactly am I testing for? Is there something alternatively I can do and it will validate this assertion? So the typical assertions they look at for revenue are occurrence, completeness, accuracy, cutoff, classification, and presentation. Those are the assertions that you seek to validate whenever you're auditing revenue. So knowing that, it will assist you in terms of your approach. And even if something is missing, say, all right, this record is missing, but I'm trying to test for completeness. What else can I use to validate completeness? Now, I look at this, but I'll tell you that I know in terms of time, sometimes, diminishing returns. So I think probably you can look at, so this is basically a quick scenario, identify and explain the principal matters to consider when auditing the revenue of Laxman Company. We have the approach, and then of course we have the solution at the end. The 2 principal matters you need to consider are interrelated in this particular question, because you have a loan, and then you have something in terms of how they recognize the revenue, and it is dependent on some conditions being satisfied. So this bank loan is dependent on some conditions being satisfied. So it's good to look at on a fresh mind, and then looking at the solution that will help. So as small as a question, look, you see how detailed the response can be, and of course you can reach that level of detail, or you don't need as much detail, but as long as you use the basis. So 1, audit procedures, what are the 5 things? Okay, 2, what's the relevant standard? And 3, what are the assertions I'm testing for? Once you do that, then should be A-OK. And that's pretty much it for our session today. And that completes session number 1.